Hello, everyone. Welcome to this week's Financial Flash. I'm Mark Gierach, and I'm going to provide our current thinking on an old topic, Bitcoin. The market for cryptocurrencies has exploded over the last decade with an almost unfathomable amount of speculation. When an asset like cryptocurrency realizes a parabolic rise, one really needs to question why the rise occurred. Unlike traditional investments such as stocks, bonds, or real estate, Bitcoin lacks intrinsic value. Stocks are tied to a company's performance, and real estate generates rental income or appreciates based on location and demand. Since its inception, Bitcoin's price is primarily driven by speculation and hype rather than any tangible economic factors. The speculative nature of cryptocurrencies is analogous to the baseball card market of the late 1980s and 1990s. At that time, collectors and investors believed baseball cards had a scarcity value. What was eventually found out is that some baseball card companies kept on printing cards, and the scarcity value quickly eroded. The cryptocurrency market faces similar risks. Its value is only as strong as the next buyer's willingness to pay, making it highly vulnerable to market crashes. It is true that Bitcoin is limited in supply, and that some people may lose access to their digital wallet, making Bitcoin specifically more limited. The lack of scarcity issue arises because there are coins that have been created and work similar to Bitcoin. If the cryptocurrency market continues to develop and create new coins indefinitely, there is no scarcity value, just like baseball cards from 30 to 40 years ago. Another major risk associated with Bitcoin is the potential for increased government regulation. Regulatory actions could range from taxation policies to outright bans on cryptocurrency trading and mining, which could significantly impact Bitcoin's value and liquidity. The current U.S. administration is rather enthralled with Bitcoin and cryptocurrencies, so this risk is mitigated for the time being. Increased compliance requirements for exchanges and financial institutions could make it more difficult for investors to buy, sell, or store Bitcoin securely. While Bitcoin has significant limitations, some argue that it could serve as a viable alternative in the event of a major economic collapse, particularly if the U.S. dollar were to lose its status as the world's reserve currency. A situation in which the dollar collapses could be triggered by hyperinflation, unsustainable national debt, or a severe geopolitical crisis leading to loss of global confidence in the U.S. financial system. In such a scenario, traditional banking systems could fail, making decentralized assets like Bitcoin a potential alternative. We feel that even with the current U.S. debt situation, there is a small likelihood of this dynamic occurring. Bitcoin remains a highly speculative asset with substantial risks. The rise in value of Bitcoin is mostly due to speculation and a hedge against financial calamity due to failure of traditional fiat monetary systems. The parallels to the baseball card bubble of the 1990s serve as a cautionary tale. When speculation drives an asset's price rather than fundamental value, the potential for a market collapse increases. Investors should approach Bitcoin with caution and carefully consider why they would want to own it. As the weather here in Minnesota is starting to turn around, the outdoors is becoming a little more enjoyable again. Hopefully everyone can find some time to enjoy the upcoming balmy weather. Have a great weekend, everyone.
The Financial Flash is created by the experts at Styles Financial Services, creating customized portfolios that fit your unique lifestyle and goals.